The International Energy Agency has trimmed its forecast for 2024 oil demand growth. Welcome to Market Insight. I'm Ramzan Karamali. Well, the IEA's downgrade came about due to poor industrial activity and a mild winter in Europe. It also now widens the gap with oil producer group OPEC in terms of expectations for this year's outlook. Well, for analysis on the IEA's latest report and more, I'm joined by Victor Katona, Head of Crude Analysis at Kepler. Victor, thanks so much for joining us. So what did you make of the IEA's report, and what does the widening gap between what it and OPEC believe when it comes to output actually mean for prices?
Well, I think that OPEC was hitting its pricing forecast in 2023 really, really well. But in 2024, it seems that the IEA is the one that ultimately reacts to what we actually see, a genuine slowing down in economic activity. I think the 1.1, 1.2 range that they are targeting for, the fact that they even moved their demand outlook, ultimately suggests that they are reacting to what's going on, and I wholeheartedly agree with their assessment. Effectively, oil demand will not grow as fast as it did last year, and it's a reflection ultimately of the woes that we experience right now. So effectively, right now we have a situation when OPEC's demand growth for 2024 is double of the IEA's, and I think that's quite a peculiar situation. We've never had this in history. And I think that IEAs will be on the right side of history, ultimately. It's the correct assessment. We need to be cautious about demand.
Victor, we hear from OPEC very soon, though. Do you think they'll change their forecasts?
I think OPEC will decide to go with a rollover. Despite their forecast, which should be very upbeat, and ultimately the forecast should be reflected in more crude coming into the market. But I don't think that at the bottom of their hearts, they ultimately believe that the situation is that optimistic. They'll exercise caution. They understand that despite higher inventories, despite a huge growth in Asia, which they forecast, it doesn't necessarily feel that good with the macroeconomic background that we currently have. So I think it's a rollover.
Now, turning to economic news, and we've just had the latest inflation data out of the US, a headline rise of 3.4% on an annualized basis for April. Now, we know the US is the largest consumer and producer of crude oil, so what will this sticky continuing inflation mean for oil demand?
Well, it's definitely bad news for oil. And I would even argue that the United States has become something of a constant source of bearish news. Because wherever you look, be that gasoline demand in the US, a good 300,000 barrels per day lower than where it should be. Diesel demand in the US, again, 300,000 barrels per day lower than it should be. And then the macroeconomic news, which pretty much suggests that there won't be any big interest rate cut in 2024. We'll be lucky if we have one cut ultimately this year. So it's effectively all coming together. And I think it's the beginning of the end for US consumption growth. I think US oil demand is pretty much peaking right in front of our very eyes. And it's the signals that the market is ultimately sending us. It will be higher for longer, and for oil demand from the US, as you said, pretty much the biggest consumer globally, it's bad news. From here onwards, it will be a long decline.
Well, if it's bad news from the biggest consumer, let's go to the next biggest, and that's China. So are there any signs demand there could rise?
As a matter of fact, China is looking quite interesting, because everyone expected Chinese oil demand to suffer from the construction sector weakness, to the massive government debt or regional debt that they've amassed. But ultimately, what you see in the markets right now is that China is buying a tremendous amount of crude. Every single month in 2024 has so far seen a month-on-month increase. So effectively, they are buying, they are refining, and they're exporting a great amount. And I would even argue that China is the counter argument to the demand weakness that's coming out of the US and coming out of the Atlantic basin so far. Of course, it won't be growing forever, but right now in the first 5 months of 2024, China has so far been a source of positive news for oil.
Now, since the last time I spoke to you, sanctions against Venezuela had been lifted. They're back on again now. How much of an impact are they having on prices?
Well, I would argue that on flat prices, they don't really have an impact, because the sanction snapback was largely ignored by Brent and WTI. However, they have, again, a very big impact on China, because China is back to what it's doing best, what it really loves, and that's mopping up literally every single sanctioned cargo that it can think of. It's mopping up all the Iranian cargoes, Venezuelan cargoes now. Here we go again. Effectively, they're coming back home to China. Russian cargoes if they come. So ultimately, China is collecting them all at a really, really steep discount. So for them, the tighter the sanctions, the better the Chinese refinery situation overall. So they are loving it.
Victor Katona from Kepler, many thanks for your thoughts as always.